Welcome back, everyone, to today's Explainer. I am absolutely pumped to guide you through this one, because today we are unpacking day 20 of our crypto trader curriculum, which is all about futures and leverage. Now, if you've been following along, you know we've nailed down the basics of market dynamics, right? But day 20, well, this is where the training wheels completely come off. We're looking at some of the most intense, high-octane tools out there in the market. So get comfortable, and let's dissect exactly what these concepts actually mean.
But before we get bogged down in all the dense terminology, I want you to ask yourself a quick question. How exactly do crypto traders magnify their positions? You know, we constantly hear these wild stories of traders capturing massive upside from just relatively small market movements. Well, it's not magic, I promise you. It's pure mechanics. It's all about utilizing very specific financial instruments to drastically increase their market exposure. And that's exactly the high-stakes world we're going to demystify for you right now.
Okay, let's dive straight into this. Here's our roadmap. First, we'll cover the crypto futures landscape. Second, margin and leverage explained. Third, navigating perpetual contracts. Fourth, the liquidation danger zone. And finally, number 5, the paper trading rule.
All right, Section 1, the crypto futures landscape, betting on direction.
So in this landscape, there are basically 2 fundamental directions a trader can take. On one side, we've got the long position. Simply put, this is when a trader is betting on a price increase. If the asset's price goes up, boom, the long position gains value. On the exact flip side of that, we have the short position. This is where you're actively betting on a price decrease. It actually allows a trader to potentially profit even when the market is tanking. These dueling concepts, long and short, are literally the bedrock of the futures market. Basically, every advanced trade we're going to talk about starts with choosing a side right here.
Moving right along to Section 2, margin and leverage explained. This is all about adding fuel to your trades. To really understand how traders add that fuel, we first got to define the essential building block, which is margin. According to the Day 20 curriculum, wrapping your head around margin is an absolute prerequisite. Think of margin as your necessary foundational step. It's essentially the initial collateral, or, the required deposit that you absolutely must have to enter into these advanced trades. You literally cannot play in the leveraged futures market without putting down this collateral first. Basically, it's your skin in the game.
So let's look at how this builds into a complete strategy. Step 1, you post margin. You put down that initial deposit we were just talking about. Step 2, you apply leverage. Once that collateral is locked in, well, that unlocks your ability to use leverage on the platform. And finally, step 3, you magnify the position. By actively chaining those first 2 steps together, the end result is a massively magnified exposure to the market. You're now commanding a position that is significantly larger than what your initial margin deposit alone would ever allow.
Now, the absolute crucial point here is understanding exactly what leverage is in that second step. Leverage, at its core, is just borrowed power. It's the mechanism that uses your margin as a base to radically increase your potential market exposure. If you put down just a small amount of margin and apply a high degree of leverage, you're effectively controlling a massive financial footprint in the market. It just accelerates everything, allowing traders to maximize their capital efficiency at a super fast pace.
But, and this is a massive but, there is a critical warning we have to highlight here. Leverage magnifies losses and liquidation risk. This borrowed power cuts both ways, folks. Just as it can amplify a winning long or short position, if the market happens to move against you, your losses are amplified by that exact same multiplier. It is absolutely a double-edged sword of the highest order, and respecting that extreme risk is completely paramount for any trader out there.
All right, Section 3, navigating perpetual contracts, the instruments with no expiration date. When you're trading crypto futures, you aren't always dealing with traditional financial instruments. You're actually often dealing with a specific vehicle that's heavily utilized in the crypto space, and understanding its unique mechanics is absolutely essential for your journey. A core concept you really need to master is the perpetual contract. So what exactly makes it perpetual? Well, unlike traditional futures contracts that have a hard expiration date, like a specific day at the end of the month where the contract absolutely has to be settled, perpetual contracts have no expiration date whatsoever. This means a trader can hold a longer short position indefinitely, just rolling it over day after day, as long as they maintain enough margin to keep that trade alive.
But you might be wondering, how on earth does a contract that never expires stay aligned with the actual price of the asset? Well, that brings us to another really vital concept from our source material, funding rates.
Since there's no settlement date forcing the price to eventually resolve, the market uses funding rates as this clever, hidden mechanic to keep the perpetual contract tethered tightly to the actual spot price of the asset. It's essentially a recurring cost or a recurring payment that gets exchanged directly between the traders themselves just to ensure the contract price doesn't go drifting off into fantasy land. Now, depending on the overall market conditions, the funding rate essentially pushes money from one side of the trade to the other just to maintain balance. If the perpetual contract price is trading too high, longs pay shorts. This naturally disincentivizes going long and actually rewards going short, which pushes the price back down. On the flip side, if the contract price is trading too low, shorts pay longs. This rewards the longs, penalizes the shorts, and drives the price back up. It's honestly this brilliant continuous balancing act of capital flow happening between actual traders to maintain total market equilibrium.
Moving to Section 4, the liquidation danger zone. This is the ultimate danger.
Okay, this right here is the absolute worst case scenario of a leveraged trade gone wrong. Liquidation. Let's say you take a leveraged position, maybe a long position betting the price goes up, but then the market violently drops against you. Your losses are rapidly magnified. If those amplified losses eat through that initial margin deposit you put down, the exchange steps in. Liquidation is basically the sudden, forced closure of your position by the trading engine. The system just automatically sells your position to prevent any further losses, and in doing so, it completely wipes out your margin. Your initial collateral is just gone, literally in the blink of an eye.
Which brings us to our final section, number 5, the paper trading rule, or how to practice safely. Given the absolute extreme stakes of everything we've just talked about today, the curriculum leaves us with one incredibly crucial takeaway. Use paper trading for practice. The text is super explicit about how important this is. Now, paper trading is just simulated trading. It's using fake money in a real-time live market environment. Before you ever even think about touching real capital, before you ever post real margin or apply real leverage, practicing these advanced mechanics without financial risk is an absolute necessity. You really have to understand just how fast liquidation can happen on a practice screen before you ever let it happen to your real bank account.
And that brings us to the end of our explainer today. I want to leave you with this final thought to really chew on. Based on the incredible power and, frankly, the extreme risks of Day 20's curriculum that we just outlined, are you actually ready to practice, or are you just playing with fire? Seriously, take the time, learn the mechanics, use the safety rules we covered today, and truly master the structure of futures and leverage before you take that leap. Thanks so much for joining me for this deep dive. Keep focusing on your learning, and I'll see you in the next explainer.